Everywhere you look, headlines are screaming, buy stocks, hedge with gold, ditch cash. And honestly, all of them can be right, but one decision quietly costs people thousands of dollars, even when you pick the right investments. It's not what you buy, it's how you enter the market. Most people dollar cost average because they feel safer. Others invest a lump sum because the math says that it should win. Here's where people get hurt, not from picking bad stocks, but from choosing the wrong entry strategy for them. And this mistake doesn't show up right away. It shows up right after you invest. And in this video, I'm bringing down both approaches using real data to show you which one actually comes out on top. Let's dive in. And when I actually look at the data, one of these strategies win most of the time. But to understand why, we need to be clear on what each one actually means. Let's start with lump sum investing. This is pretty simple. You want to take the money you want to invest and put it all into the market all at once. And if you have 100,000, it's invested immediately. Now, dollar cost averaging or DCA means spreading that same money over time. Instead of investing all at once, you invest smaller chunks on a schedule. For example, $10,000 a month over 10 months. This is the same amount of money, but it's deployed in very different ways over time. So the obvious question is, which one actually performs better over time? And Vanguard did a study across the US, the UK, and Australia. And this is where the results surprise most people. Lump sum investing beat it dollar cost averaging about 2/3 of the time. And once you see these results, the next question becomes, why? So why does lump sum investing outperform? If this breakdown was useful so far, hit like and subscribe so it can help more investors like you. So the reason is simple. Markets have gone up more often than they've gone down. So the longer your money is in the market, the higher your expected return. But if it's really that simple, why doesn't everyone just do it? Because the trade-off isn't really about returns. It's about how you react when things go wrong. Now, lump sum investing gives higher returns, but it hits you emotionally all at once. So if the market drops right after you invest the whole thing, it feels like you've made a mistake, even when you know you did the right move. Now, dollar cost averaging flips that. Your returns are usually lower, but it's a lot easier on your nerves because you're easing into it instead of jumping all at once. So this isn't a question about intelligence. It's a question whether you can stay invested when your portfolio is down 20, 30, even 50%. And this isn't just a theory. We actually saw this happen in real life. In early 2020, during the COVID crash, the S&P 500 fell more than 30% in just weeks. And if you invested a lump sum right before that drop, your portfolio would have been down almost immediately. This is the moment most people sell, not because they're wrong, but because we are human. And in moments like that, dollar cost averaging does look better in the short term because you're buying as prices fall instead of putting everything at the top. And to be clear, this is the strongest argument for dollar cost averaging. But here's the part most people miss. This is where investing stops being math and it starts being human. On paper, lump sum investing usually wins, but in real life, losing money hurts way more than making money. And this is why Warren Buffett thinks about this differently than most people expect.
If you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time.
He's not trying to get the highest return. He's trying to stop people from panic selling. That's the key point. Buffett isn't saying dollar cost averaging makes you more money. He's saying it works better than panic, better than regret, better than doing nothing. Because for most investors, the biggest risk isn't the market, it's your own behavior. And that brings us to a takeaway. The best investing strategy is the one you'll stick with. If you can invest a lump sum and stay invested even when the market drops, lump sum investing probably makes sense for you. But if a short-term drop would make you panic, or second guess yourself, or delay investing altogether, dollar cost averaging is the safer option. Not because it makes more money, but because it's easier to stick with. And if you're somewhere in between, there's a simple middle ground. Invest part of your money now, and then dollar cost average the rest over a short period of time. If you find my video helpful, you're gonna probably like my video on 6 habits of quiet millionaires. It goes deeper into behaviors that actually matter long term. So I'm gonna link it here. Click it. I'll see you there. Yeah, click it.